This meeting is being recorded.
Hello, everyone, and welcome to this session as part of Amplifying Our Collective Voice, the Native CDFI Capital Access Convening for OWISTA. My name is Gabe Del Rio. I head up Homeownership Council of America. I'm joined by my colleagues, Don Nash and Jennifer Murphy, both vice presidents with us. And we're here talking today about becoming a mortgage broker. We work with CDFIs around the country on this issue, and it's something to consider. We're going to go through some of the factors today that you would think through if you are considering becoming a mortgage broker. And we'll go over the learning objectives in just a moment. But we're going to kick off with some comments from Cheryl Peterson, who's the education lead from Fannie Mae, joining us today. Cheryl?
Thank you, Gabe. Hello, everyone. So my name is Cheryl Peterson, as Gabe said. So I work on the affordable lending team at Fannie Mae. My colleague, Ben Navarro, unfortunately was unable to join today due to a personal conflict, but he tells me he's excited to watch the recordings. So together, Ben and I work on expanding Native American homeownership for Fannie Mae, and we're happy to join the event because we know how critical Native CDFIs are to reaching these consumers. So Fannie Mae's work in Indian country is diverse, including developing agreements with tribes and lenders to expand loan options on trust land and expanding availability of homeownership counseling to Native Americans and providing resources and support to Native American housing developers. But today we're here to introduce our partners from Homeownership Council of America, who work directly with Native CDFIs and are interested in becoming mortgage brokers. We're proud to support this important work, and we look forward to discussion with you today and in the future. And so on that first slide, it has both myself and Ben's contact information. So thank you all.
Thank you, Cheryl. And I'll put the information back up there for anyone who'd like Cheryl's email and phone number, as well as Ben Navarro, who we meet with regularly ourselves as a partner there. Great folks to know, and I would say Fannie is a really great partner in the industry. So thank you, Cheryl. All right, let me move on to our next slide, if I can get this to move. Okay, so this is something we call CLIMB, Community Lending Initiatives in Mortgage Banking. That's a big program here at HCA. It's our main program. Although Equity DPA is a new exciting thing that will also be a mainline program here at HCA. But CLIMB is where we engage with mostly nonprofits and CDFIs, including Native CDFIs, as well as for-profit lenders and credit unions. And what we do with this program is we help folks to, in the nonprofit space, we help move up the lending ladder, as we say. And that starts with packaging, goes next to down payment assistance lending, then to mortgage brokerage as the first entree into first mortgage lending activity, especially conventional or on fee simple land in the Native CDFI space. For-profit entities, we work on affordable programs, and more these days, we're really excited to work on special purpose credit programs. And those are programs that are credit offerings that can be designated or focused on a specific protected class, which includes race and ethnicity. So it's an exciting development. A lot of Native CDFIs already have this focus and don't need to call it a special purpose credit program, but we're excited to see that mainline lenders are now taking on these programs, whether mortgage banks or banks. A little bit about HCA. We're a national nonprofit organization. We've been around since 2006, and really our CLIMB program's been active for the last 3.5 years. We have a uniquely experienced team that has mortgage lending experience, nonprofit housing development and management, HUD-approved services, and counseling, and CDFI management. And all of myself, Jennifer, and Don that are joining me today, we all share those same experiences. And it adds up to a lot of years, and we bring all of that knowledge and best practice to bear for our partners. We're excited that when we work with them, we see transformation and growth and success. This is our mission: building equitable access to credit for America's underserved communities. That would certainly include rural communities and the Native community. Uh, There are our learning objectives for the day. We're going to go over how to evaluate your organization's potential lending abilities. So thinking about, do we have the right business model, the right volumes, the right demands to get into this space? And we'll talk about the steps necessary to build a mortgage brokerage. We'll also talk about the staffing and roles, which really helps in planning for your organization. And then we'll also identify some lending relationships or show you some samples of how you could look at that and what to look for. So starting off, what is a mortgage brokerage? We haven't seen clear understanding around this, so we want to make sure to pause and go over it to review. A mortgage brokerage is really a licensed middleman, so to speak. So you are brokering. The activity of brokering means that you're interfacing with the client and you're acting as the originator in that space. And then you are on the other side, originator or interacting with multiple investors. And those investors are wholesale lenders. And so the broker themselves is really gathering the borrower's information, putting together the application, shopping the different loans that they have available through those wholesale investors, and then passing the application through to that wholesale partner. That lender becomes the lender of record. That lender pays the mortgage broker for the origination. And that's generally 2.5% I would say 2 to 3%. So somewhere in that range of the loan amount. And so that's what the origination fees that come back to a mortgage broker look like. And that's the activities that they're engaged with. You see that they do not lend their own money, okay? So while many native CDFIs and CDFIs in general may have direct loan programs, when they become a broker, on those brokered transactions, that will not include their own money unless it's layered as a second lien or down payment assistance along with that brokered first mortgage. Mortgage brokers do not underwrite the file, do not approve the mortgage. Really, they're focused on origination and submitting all of the application requirements and the qualification requirements of the loan program and the investor. Let's look at the activities involved with mortgage broker versus direct lender. So mortgage brokers on the left-hand side really bring mortgage lenders and borrowers together. They help borrowers to find the best match by shopping loan programs that they have available through their wholesale channels. They're paid by those lenders to originate the loan. And they're really responsible, they're the primary point of contact for borrower communication. And that goes all the way from application through approval and closing to ensure that you are there to engage with the consumer and help them through the process. On the direct lender side, the bank or institution actually approves and funds the mortgage loan. So they are performing the underwriting and they are the lender of record because they have funded the loan and they close it. This means that they're lending from their suite of products, the products that they offer on that wholesale channel, and they're generally compensated by loan sales primarily, in addition to fees and rate spreads. The lender is responsible for all final processing, all final disclosures, underwriting, and closing and funding. So a broker in the world of compliance really does the upfront disclosures, what we call the 72-hour application disclosures. And that's it. From there, once they send that to a lender, that lender will replace those same disclosures and will continue the full TRID disclosure process through closing. And this is really done to benefit consumers so that consumers have a set of disclosures from the lender which they will receive the loan from that go all the way from application, replacing the broker's application disclosures, all the way through the closing disclosure. So let's pause here for a moment and get any Q&A around what a broker is, what they do, and any more clarification that would be helpful to you all. And you can just unmute, or you can put your
type in
questions
the chat.
Right. And if we don't see any, that's okay.
Don't see any.
Nothing in the chat? Okay.
Nothing's in the chat.
All right. Well, now you know clearly what a mortgage broker does and doesn't do. Primarily not lending their own funds. Let's look at the steps to becoming a broker or having a brokerage. We always start with board approval. You don't want to start going down this road without having at least strategic directional approval for the board. They can have other stages and gates to approve throughout this process. But considering this activity is essentially a new line of business. And so that should really start with a discussion with the board and making sure that it's in alignment with what they'd like to see the organization do. Additionally, you'll find if they have any questions in that process, and folks like us are happy to help, but you also can find all of those answers. There are thousands and thousands of brokers around the country, and you all are very capable and competent organizations. So there's that first step to get through. Next, we look at reviewing the NMLS broker license. And really, you have options as a nonprofit. You can go for an exempt nonprofit status in some states, and you can also get a non-exempt license. When we recently looked at this for a native CDFI that was incorporated under their tribal council, they had been refused, or actually a similar organization had been refused exempt status in their state. However, they fully qualify for the non-exempt status. So it was really due to not being able to check the right corporation type box because they didn't have a 501c3, and that's what prevented the exempt approval. However, again, they have all of the financials, the qualifying staff, and the organizational history and track record to qualify as a non-exempt organization. So you've got to look at that for your state, for your organization and entity type, and make sure that you get or that you match up what you apply for there. Again, if you need advice around this is something that we help with. But I'm trying to give you the key there, that if you don't have the 501c3, then I would not go exempt, and I would go for the non-exempt pathway. You'll find that it's not terribly difficult to do that. It's really important in that process, once you're ready to kick it off, to identify your qualifying individual. There will need to be a responsible qualifying individual in the corporation, in its management and leadership, acting in an officer type role. It can have very limited purview in doing this work, but does need to have direct line of sight to this lending activity that will be licensed so that they can help manage it and help maintain compliance. You also want to take a look at staffing gaps and whether you have any or whether you have the right folks on the team to be able to support the mortgage brokerage activity. This will require an NMLS licensed loan officer or someone who is licensable who could get that license. And I do want to say we've seen many organizations have their staff go through the training and attain that license. So you don't have to already have it. Many of the qualifying individuals that we've worked with over the years often have the experience, but may not even be licensed. So that's really about your experience and time in the industry. It's a measure of someone's resume more than it is a licensure. And so those are not terribly difficult, again, as long as the leadership has strong background in lending. Other steps, review the current insurance policies. We know that when you apply for either your brokerage approval from a wholesale lender or from your licensing, you're going to need to have your insurance policies in place. And on this, we generally find that folks have the general liability policies, umbrella, but what you're really looking for in the mortgage broker business is called errors and omissions or professional liability. And errors and omissions or professional liability insurance cover you as the broker from accidentally misrepresenting or misstating information. And because that can be a real issue in a loan and it can cause financial damages, these kinds of insurance cover when that occurs from a mistake, and mistakes do happen. And so this is a really critical insurance to have in place, and it is required for most or all wholesale channels. You will have to obtain a surety bond in your state if your state requires it. A surety bond is actually a small expense. They're usually about $500, but it is a surety bond that will go to your license and will be there connected to your license if you have any claims against it, and it's something that the state can trigger payment of. You will then, once you've acquired all of these things, put these things in line and know that you meet the application requirements, you can submit your application to NMLS. NMLS manages all of the state licensing and the national licensing for mortgage brokers. So you will find that even if your state has a department that does it, they will have the NMLS system 99% of the time be the way that you submit your application and the way that you interface with them. Finally, if you've done all of these things and submitted an application, you should receive an approval. Be licensed as a mortgage broker. Let me pause there and see if there's any questions.
I have a message in chat. Sid.
How long does this process usually take? It depends on the state, really. So in some states, you can get an application approved within a month. In other states, that can be 6 to 12 months. So it really depends on your state, how backed up they are. And there is a difference between requesting an exempt license and a non-exempt license. We do see that non-exempt licenses are processed faster. They are not sort of requesting an exemption from the rules. That request of exemption from the rules, so to speak, is what triggers an individual to review. And that may only be one individual who issues exempt licenses for that state. And so those can get backed up from time to time. You can call you can call into the NMLS. They actually have really great customer service, and you can ask about your state and see what the timelines look like. Hopefully, you're going to get this done in no more than 90 days. And we've really seen that the vast majority of states can get this done, and organizations we've worked with within 90 days. All right, if nothing else, I'll move on to the next section. Go. So let's take a look at a typical mortgage brokerage staffing structure. Generally, there is a director or someone in leadership who would oversee lending. In smaller organizations, that may be a hat that the executive director is wearing, or it may be the associate director or the next in line. But someone who will keep themselves up to date in the lending world, get some training, continuing education, make themselves aware of the procedures and policies, and understand compliance requirements. That's really important from the leadership perspective, to make sure that you're doing and to inspect what you expect from the staff. This person also needs to take care of all of the systems that you're using. So for instance, a mortgage brokerage, we often recommend Calyx Point. And Calyx Point is a web-based origination platform that's very easy to sort of sign up for and get launched quickly. And it's not very expensive in comparison to most systems. So that's our recommendation there. But whether it's that or Down Home or any other program or system that you're using, the management and leadership is going to have to take care of that. They'll also be interfacing with the wholesale lenders, so having a relationship management duty with your wholesale providers and all of your third-party vendors, as well as your annual reporting. So all of those things kind of fall under the leadership bucket there in the yellow box. The orange box is requisite in this space, really, processors. Processors are critical in mortgage origination because they ensure that we issue those upfront disclosures. We process all of the documents that each lender needs, and we upload them into their systems. And so this is a really critical role. If you have enough volume, folks also often trigger a junior processor. So someone who is focused on the startup of a file, usually opening escrow, ordering title, getting all of the third-party verification reports ready to upload, those things that happen right at the beginning of opening a qualified applicant in a real transaction. The processor then focuses on ensuring that you've got that you're maintaining compliance and reporting and meeting all of the lender's stipulations. Because when you go for underwriting with a file, you will submit that to the lender. The lender will then underwrite the file and give you underwriting findings, and that will provide your conditions or stipulations in order to receive that loan. The processor will manage that list and will also interface often with the client directly to get all of those requirements met and to upload those documents in a timely fashion. They're also going to sort of transaction coordinate and make sure that your borrower is prepared for the closing, that they've got their EMD, their earnest money deposit, and any other cash they need to bring to closing, as well as sort of maintaining all of their documentation throughout the process, keeping their pay stubs and W-2s, et cetera, up to date. The final rung here on the ladder is the mortgage loan officers or mortgage loan originators. And MLOs, we've shown you 4 here. It's not that often that you would do this many, but certainly you can build up to this. And I would say that when it's a for-profit entity opening up a mortgage brokerage, they would for sure hire at least 4 loan officers, because loan officers do tend to come and go, and some of them don't succeed. And this is a very commission-driven position, and it's not for everyone. So you have to be prepared for someone that you hire to not work out potentially in 6 to 12 months. And you don't want to hold on to someone who's not producing or it's not working well for, especially in a commissioned role, because they're not going to be making much money. But if you've got, let's say, 4 producing mortgage loan originators who are at their full hilt and maybe another 5th or 6th on there, that would trigger this kind of setup with 2 processors, a senior processor and a junior processor. So next we're going to look at the typical volumes per position so that you can think about what that chart might look like for you. Processors for brokers can typically handle 40 active loans in their pipeline. So that means 40 loans that are being juggled at some stage of their process on any given day. And what that means is that you've got 10 to 20 of those loans closing in the month and 10 to 20 new loans entering the pipeline. So there's always a constant churn of new files coming in and old files or files that are completed being closed and moving out. But the active load is 40. We often do not see anywhere close to these volumes with nonprofit expectations in processing. So we like to share this metric. This is a very, very standard metric across 2,000 plus lenders in the country, and this is a tried and true number that you can measure how many processors you need to hire based on this number. And lenders often use this metric to trigger new hires or reducing staff. Let's see here. The next one down is MLOs. Now, setting expectations for production there, we always recommend that an MLO be expected to close 3 to 5 loans per month. If they fall below 3 loans per month for multiple months, that would not be enough production to maintain them, likely, unless you have a really high cost market. So you really want to see a 3 to 5 loan closing ratio each month, and then you're going to have consistent revenues. They're going to be making consistent commissions, and everyone will be happy. This means, and this is also, by the way, the average loan closing number per mortgage loan officer in the country. That's 3 point something. There are lots of folks who close 10, 15, 20 loans a month regularly. Those folks also have assistants, and they have multiple assistants usually in order to close that many loans, because it is a lot of detailed work that a loan officer needs to do, and there's a lot of back and forth with the client and the lender. So in order to get 3 to 5 loan closings a month, that means that you've got to get 5 to 9 new applications a month. So think about how many folks are coming in the door who might be interested in or need a first mortgage that you could broker. And, could you keep a loan officer busy? Or maybe it's a part-time MLO with an existing staff because you don't have 5 to 9 applications coming in per month. But think about those metrics: 3 to 5 closings, 5 to 9 new applications. The typical ratio for MLOs to processors really is 3 loan officers to 1 processor. And that's because if you look at these numbers, you would have to have about 3 loan officers to meet the requirements to get 10 to 20 new loans a month and 10 to 20 closings per month, which the processor would be managing. Final point on here is that mortgage loan officers are typically commissioned salespeople. We recommend that you start with a draw on commission and that you give people a runway of time. That draw you can make forgivable during that runway. And that means that you as an employer are limited to, let's say, 90 days of a minimum draw that you will give someone runway to succeed. At the end of that period, they should be paid based on their commission. And we provide sample commission structures and tiered structures that are standard in the industry. It's really important when you're hiring MLOs to be competitive in pay and to know that MLOs are consistently recruited by lenders. So you don't want to be too far off from how a typical lender might pay a mortgage loan officer, even if you've really gotten that mission light in their heart to glow brightest and that they're really committed to your mission, which is what we would love to see happen at all CDFIs, and I think what you need. But you've got to still pay them well, and you've got to incentivize them to do more and to close more, because that model of commission and incentives that drive you to closing more is a proven production model within the mortgage industry. So let me pause there and see if you have any questions on staffing and planning your staffing or planning volumes that would be helpful to you.
Hey, Gabe, it's Joanna.
Hey, Joanna, how are you?
Good. I have a question. So, hold on. I was walking right when you said, let me get off here. So, I totally hear what you're saying about the commission being a proven model that works really well to provide incentives.
Mm-hmm.
Have you seen kind of a hybrid model with CDFIs where the CDFI pays somewhat of a salary and maybe a smaller commission?
Absolutely. And they're not only in CDFIs, but in small community banks and credit unions. This is often a model, especially in rural markets too, that have lower volumes in general, that you might have that loan officer wearing a couple different hats for the organization. And in that case, that's when, they have more duties than just to find loans and originate them at all in any way. Then that really, you should consider a base salary, and a base salary plus a commission structure is a typical what's called a community loan officer model. That goes across banks, credit unions, anyone who has an LMI or a community or community development focus. That model is well proven as well. It's, I would say that when banks do that, and this is something to caution CDFIs and nonprofits around, is that they're often subsidizing that in some way, and they want to and need to because of CRA. So if you've got grant sources that could subsidize that salary so that you've got them doing extra mission work and sort of deep work that may not produce much income, or doesn't produce income often enough that you need to subsidize it. If you've got those sources and you can make that work, then that's a wonderful way to handle this. We just have also seen that a lot of folks have not moved off the starting line because they think, oh my gosh, I have to pay for 1, 2, 3 people's salaries for a year before, and have that ready to go and ready to invest before I can, initiate this new activity. And so we like to show people that often in a for-profit model, that is not the case. And there are ways to reduce your liability and commitment with employees and test them out and incentivize them to replace your salary with commission. And that keeps them focused on production.
Yeah, that makes a lot of sense. It's just that, as you know, like the volume in many Native communities, it's hard. And I guess my second question, just really quickly, if you can go back to the slide with the chart, with the positions, so do you see perhaps maybe in some small startups just the yellow and orange box?
Yeah, or yellow, orange, blue. Right.
But even no blue. Maybe just
someone's got to be the loan officer.
Right. Well,
somebody has
maybe
to originate the loans.
So maybe it's just yellow and blue then.
Well, somebody's got to process. So, MLOs can self-process. Okay. It really depends on the individual. When I talk about Don, I say he's got this rare combination of compliance and sales. It is very rare to find someone who is good at customer service or sales, and who is also great at, dotting all the I's and crossing the T's and making sure every little thing is taken care of, because lending is very detailed and we have to get it all right.
Yeah, well, I think it's not common to find those folks at.
I intersperse a minute on that one. There are sometimes, this is Nancy Bainbridge at Chickasaw Community Bank. There are times when the processing can be contracted out in a startup mode, Joanna, so that if you have a mortgage loan officer who, instead of, the director of lending is typically all lending, not just mortgage lending. And so if you've got that scenario, and I've worked for large banks and small banks, you could then, till you get started and you get trained, you could contract out that processor to your upfront expenses.
Yep. Yeah, and with some words of caution with the outside processing is that where we've seen that model, especially on the lower volumes, be successful, is where the organization has some relationship or has found an individual to work on a contractor basis, and as opposed to a fulfillment company. So because in the mortgage business, there are fulfillment companies that you can outsource anything to, any part of the process. And so, of course, processing, underwriting are inclusive of that, but they generally require minimum volumes. And if you don't have those volumes, they may not work with you at all, but B, they don't give you good service. And we've seen some organizations get stumbled up by that. So I love the idea. It's
more of a contract with your partner that you're upselling to that's buying your loans. A lot of times they'll be the one that provides that service so that they're comfortable with processing. So
the processing, outsourced processing, because we have looked into it for clients. Everyone I talked to had a minimum of 100 loans. Some had minimums of 600 loans per month, not per year, per month. And most of our nonprofits aren't up to that volume. So that's one of the reasons and the cost also is pretty much the same as having a processor.
Right at that point, yeah.
At that point.
You got to do a cost of benefit analysis. And another way to think about this for smaller organizations is what are the multiple hats, right? So just as Nancy said, the director of lending is probably covering all types of lending. maybe this processor, and I can tell you there's an example in CPCDC. So, they've got a processor admin who is doing small business loans, personal loans, and will also be supporting mortgage loans. And so, you can work with a multi-hat position, as we often do in nonprofit, and that may be another way to solve for this position. But we do recommend the separation of duties between management and leadership, processing and origination. And processing and origination, together put two sets of eyes on every file. And that puts two sets of eyes to make sure that you've maintained compliance and that you're meeting all the requirements and you're taking excellent care of your customer.
Got it, thanks.
Okay, so let's think about the sales funnel. This is a graphic we like to use, and think of folks coming in the door, and who's coming in the door for your organizations now. How many folks are coming in, and how are they triaged today? What questions do you ask up front? Do you know, are you measuring how many times you have a request for a first mortgage or someone who's mortgage ready? We're going to show you a little process flow on our next slide that will break out that triage a bit better and show you the routing. But main point here is that as folks come in the door, and we always recommend that this be in person, on the phone, and really well enabled online, so that you can meet millennials where they are and intake them online. But then you triage that client, however they come in, that you triage them, and then you route them to the most appropriate service based on that triage. So that's generally assigned by mortgage readiness in this space. And so that's our mainline recommendation there in triaging, is to perform a mortgage readiness assessment and then route them based on how close they are to being ready for a mortgage. If they are in fact ready, then if they're mortgage ready, then we recommend that goes straight to a loan officer for pre-qualification. That loan officer can kick off the process, and you'll see in our next slide that they can still go back to homebuyer education or concurrently complete their homebuyer education. But we found a lot of nonprofits that think, well, counseling is first, and that does not, in fact, line up with how the rest of the lending world and who that client has choice to go to works. So we want to make sure that if someone's mortgage ready and they're interested in a pre-qualification, they're immediately helped with that. And that then moves toward the property purchase and closing. We'll take a look at the client journey here. So I mentioned there, internet, phone, intake forms that they may be submitting, or in person. That's that client coming in there, complete triage intake form. So if they, and we've got a recommended quiz that folks can do, it's only 6 questions, and it helps you to triage folks and put them in the buckets of short-term, long-term, and mortgage ready and near ready. And so each of those can be routed. The mortgage ready and near ready are both treated the same, and the short-term and long-term are treated a little differently, as you'll see in this chart. So you perform the eligibility assessment, and depending on the result, you route them. So for those that are mortgage ready or near ready, they can go to meet with a loan officer. You see the green one there. The loan officer will then work with them and get them pre-approved. And you see that they are still going to get routed as the mortgage ready yes goes down the chart there over to that purple diamond shape, and they're still going to complete their home buyer education. So we always recommend that folks go through home buyer education. If they're not ready, if they're short-term or long-term, then we propose to them the services of education and counseling. So for short-term folks, that may be more appropriate to get them into one-on-one counseling right away, so that they can get direct feedback and advice on just a few things that they need to do in order to become mortgage ready. If they're a long-term client, 6 to 12 months out of being mortgage ready, then it's great to start with home buyer education. And that way, when you do get them into counseling, which they'll still complete, then they will know all the terms, they'll be well educated and ready for that conversation and ready for their transaction. If homebuyer education, if they're longer term where they really have deeper financial issues, then you might send them to financial literacy or your financial fitness classes. If I go back to the loan process and back up to meet with loan officer, once we're in the loan hopper and we've got a pre-approval, then they can go out and shop for a home confidently. So we always recommend being pre-approved first, although that doesn't always happen. Once they do get into a sales contract, that does trigger TRID, and so you've got 72 hours to disclose and provide your loan estimate and all your initial disclosures to the customer. Once you've done so, you can complete and upload that file, usually done through your loan operating system, and that is then uploaded to your lender. The lender is the red box, and they will then perform the underwriting, final approval, and take the loan through to closing. Any Q&A on that, and I can leave the card up. All right, moving on. So we just grabbed the top 10 lenders in the country just to give you a sample. And sometimes this number is a little surprising, but I believe, Jennifer, is this the home purchase top 10?
They are the top wholesale lenders in the
wholesale.
country. Wholesale, yeah.
So these are the top wholesale lenders, the top 10 in the country. And you see United Wholesale there is a 100% wholesale lender. And we've actually had some really great feedback from CDFIs and nonprofits around the country who work with them. Who else on this? Caliber is, I guess I could point them out. Caliber does manual underwriting. So if you have a lot of sort of lower FICO or credit challenge folks, but yet they have the ability to repay and they do make sense as a loan, as a borrower, then Caliber does manually underwrite, and that's that they don't use their AUS findings. They're happy to do that manually. That's a good thing.
We get a lot of people working with Quicken is one that we hear often, but definitely United Wholesale. I'd say almost everyone has a relationship with them.
Yeah. But if you want to look at your area, this is something we do when we're working on a client with an organization. We can get this very narrowed down to your geography. We can look at the top wholesale Native American lenders in your geography and pull that list so that you can really hone in on who the best partners might be. When you're looking for partners, this is another critical step in that process, which is really to test, are you going to have the range of loan options that are best and that would give your clients and your borrowers the most options to shop from, right? Because remember, as a broker, you're essentially shopping a bunch of different loan products. Sometimes you would be shopping all of these loan products with 3 different lenders, right? So they all provide them maybe on a wholesale basis, but they'll have slight nuances to their guidelines, their overlays, and their rates. So that's a way that you would shop and compare. But you want to make sure, certainly in your space, that you've got the HUD 184, USDA, so this will get you the USDA guaranteed program, the conventional lending, always a must. Conventional lending works best with down payment assistance, is easiest, and it's the least expensive with cancelable mortgage insurance. So we always promote conventional over FHA wherever possible. And we have seen communities of color too often get an FHA loan when in fact they qualified for a conventional loan that could have given them much more savings over time and cancelable insurance. But you want to have the Govy options, as we call them, the FHA and VA. And then consider your state HFA. State HFAs often they use premium pricing, which means that they have slightly higher interest rates on their first mortgage in order to finance the down payment assistance that they provide. And so that can be a really critical solution when you have no other down payment assistance options. And so you want to make sure you have all of those. If you have your state HFA products, you will always have 100% financing outside of rural designated areas. So that's a big leg up. And it's one that realtors will also look to and ask the question, do you have all of these programs? Realtors are critical partners for loan originators. 84% of the time, a consumer goes to a realtor first, not a loan officer. So when we're talking to the realtors, we have to say, here's my deck of cards. I have all of these loan products. I've got multiple investors, and I'm going to be able to get you and your buyer the best execution or the best loan possible every time. That's the value proposition you want to make. And this is what it looks like to have a full range of loan options. You could add to this range, by the way, though it wouldn't be a brokered loan, your own in-house loan. So if I use CPCBC as an example, they do have an in-house first mortgage. We work with them to make sure that that loan is priced slightly higher than market so that it is more of a last resort, because that's what they intended for it to be. When others can't say yes and they want to be able to say yes, that's what that loan is for, when it makes sense. So they're adding their brokerage, and they'll be adding all these product options in addition to still carrying their direct first mortgage option for folks who can't get a brokered loan. And this really stretches their dollars further and lets them help more folks than their balance sheet can handle. Any questions on this section? All right, let's get into running a mortgage brokerage and things to consider here. So you'll want to identify investors. We just talked about how you might do that, what some options could be, and gain those approvals. Those investors will all have different systems to upload loans in. They'll provide you with an account representative to manage your relationship. And they have online and in-person training. So one-on-one trainings with their account representatives often who are assigned to you. And then they've usually got a whole library of training videos that can help you use their system or understand their loan products better. So once you're approved with an investor, you're going to have a whole ecosystem that investor provides all of their brokers and wholesale partners. You've got to make sure you've got MLOs, or at least an MLO. Remember, we had the commission discussion there, whether that's base plus commission or full commission. The notion is that you want to incentivize production, and that is proven to work, so that if folks are going to gain an incentive to meet their goals, then they are more likely to reach those goals. You also want to determine the best way to shop and compare all your wholesale loan product options. We recommend using a system if you have enough volume to cover the expense. Optimal Blue, there are lots of other product and pricing engines that some of them are built into loan origination softwares, but essentially a product and pricing engine would save you what I used to do when I was a loan officer many years ago, and go through rate sheet after rate sheet with a ruler and sliding it down, saying, okay, what's my rate for this program, and what are my adjustments, and what's my final rate, and then comparing all of those. What a product and pricing engine does with technology today is that you can put in the parameters for your client and the transaction, and it will, and you also, when you're setting this system up, you tell it which of your investors, so who are your investors, and all of these major investors have plugins to these systems, and that means they're publishing their rates electronically. And what you're doing is you're using the system to be your little mini Google and run your parameters up against all of your options. And then what it does is it sorts for you all of the applicable loan programs that qualify, and it usually sorts them by rate, so lowest rate first, so that you can easily shop and see which of the programs do we qualify for, what's going to be a good application here, and what's the best price or best execution for the client. Remember, each MLO should originate 3 loans a month. They fall below that, they need to be on a process improvement plan because this should be their average. If you're really a low volume area, then you could bump that down to 2. You could not be likely commission only, and I would recommend making sure they have some other things to do because that's not a full-time job. Ensure you have well-trained processors to support your MLOs. Really hard to hire MLOs out there, especially, we love it when you can get an MLO from another broker, someone who already has a book of business who you can recruit. Maybe they're in love with your mission, and that's why they want to come over and work with you. But they're still going to need a great processor, and they're still going to need their products. So you've got to make sure, these other rungs up the ladder here, that you've got those products that you can say, yes, you will have all of those product options available to you, loan officer, so that you can represent that with the realtors, because they will definitely be interacting with realtors. And then additionally, we've got a great processor or processors who will support you and will make sure that we're getting things done on time and that we maintain great customer service and full compliance. There's training available through the Mortgage Bankers Association for processors and loan officers. There's lots for underwriting. There are other trainings out there as well. MBA is a big partner of ours. We'll disclose. Also, I went to MBA School of Mortgage Banking, so I credit my nerdiness in lending to MBA. But I've seen a lot of folks go through these programs over the years, and they're really fantastic, deep education. And they have it broken down to each role and each step. If you're going to take place in that training, would recommend you join as a nonprofit. They have a nonprofit rate, but that will get you a discount, so you're not paying the full price for those training programs. They also have scholarship programs if you are a female or a minority, and so it's worth applying. I think we're recommending CPCDC, and when they put their application in, we asked them to send it to us so we can make sure that our friends over at the MBA put attention on that and see if we can get them those scholarships. And then finally, you want to market your services to realtors and partners and in the community that you serve consistently. It's really important. You can have the best things since sliced bread, but if you don't tell people about it, and you're not out there saying to realtors, home builders, other businesses, other nonprofits, etc., your elected officials, what you do, and that you have those loan programs and the ability to close first mortgages at your organization and provide those to consumers, then they won't know. And this is very much a referral and relationship business. And so you really want to put in the time and put out the messaging out there. That is a critical step, and it's often overlooked by nonprofits. Now, you don't need to do this if you've got a massive pipeline at your door. We've had some organizations that literally the phone rings off the hook, the leads are always coming in, and they don't need to market. Now they could grow if they marketed further from there, right? But if that's what you're looking at from day one, you might not need to do this. But by and large, I would say folks do need to think more about marketing and get out there. And MLOs, you really have to make sure they are not just sitting at their desk, especially if they're a salaried plus commission, they've got to get out in the community, make sure they're doing presentations, open houses with realtors, dropping by the realty office, meeting with new folks, going out with flyers, going out with marketing material, etc. They really have to get out there in order to get that business. And that's a really important step. And it's what lending companies do, as a standard course of business. So you've got to get out there and tell folks. So we wanted to sort of wrap up in just thinking through a bit of a SWOT analysis and giving you some examples here. I think we're putting this in the chat. You're welcome to download that graphic and maybe fill it in for yourself. But thinking through strengths, weaknesses, opportunities, and threats as it relates to opening up or embarking on a brokerage line of business. So here's what we put in there for some strengths to consider, right? If these things, if these are your strengths, they're probably good. If you have lots of demand for new clients that are meeting the organization, like I just talked about, then that is a good place to be. If you are referring people to lenders on a regular basis, that is what you will see. That's what it looks like. That you are consistently meeting or making mortgage-ready consumers, and that you send them out the door because you don't have the loan for them. That is the place you really, really want to be. What other natural partners or referral sources do you have? Maybe you've got a local housing counseling organization or other referral mechanisms where you are consistently being sent clients that you can triage for this need. That is a really strong strength. If you have down payment assistance programs that could be added or to leverage a first mortgage product, that is the best thing to have, and will generally drive that first bullet, which is lots of demand. And I would say in today's raising interest rate environment, down payment assistance programs, you will see, will become more and more sought out, and people will come out of the woodworks looking for nonprofits and CDFIs to help them in an environment where the interest rate is now 3 times what it was just months ago for the average consumer. Just was on a Fed talk earlier this morning, and MBA was quoting that the average closing mortgage payment, pity payment, is 30% higher today than it was just 60 days ago. So some weaknesses to consider that would maybe cause pause in working to this. If you have low demand or client volumes, if you have no one requesting a first mortgage that you don't have, if you don't send clients out to partners, if you aren't creating mortgage-ready consumers on a regular basis, then that would look like this low demand or client volume. If you lack referral partners or people who could send you those clients, right, that would be another weakness to cause pause. If you have no experienced lending staff, that is definitely cause for embarking on this. If you're only attracting low and very low income clients, this is something we do see consistently around the country, where messaging, branding, everything that the organization has communicated over many years has given them a low income brand or a very low income brand, and their programs are attracting folks that are nowhere near homeownership ready or mortgage ready. And so if that's the case, that is another issue to think through and to work on more before you get to this place. And because in homeownership, generally need to be in that 70 plus AMI category. And we've seen that communities of color are actually more frequently successful up the income ladder. So back to that DPA, if you really have a focus on the Native community or other communities of color, you might find that that your down payment assistance should not be limited to low income status. That in doing so, you are also saying you need to be low income to come here. And we can tell you that the data shows that the need is way beyond low income, and the readiness is much greater in the median income or slightly above median income. We swing over to opportunities, thinking about, do you have market growth? I can use CPCDC again. They've got some really fantastic development that are long-term jobs that are coming in, and those jobs and these manufacturing facilities and shipping facilities are causing new housing to be built. So they've got new inventory going in, literally hundreds and hundreds of units over the next few years. And so that's a really exciting market to be in. And if you are an anchor in your market, then you'll want to be a part of that growth. If you don't offer the full range of first mortgages that you could broker, and you only have your portfolio product today, then you will not likely be in the running as a preferred lender for any sort of development, because developers and sellers are going to want the full range of loan product options for any buyer that's coming to get their property, and gives them the widest choice. So another opportunity is to build on existing second mortgage or DPA offering. If you have been doing down payment assistance or second mortgages really well, and that's been going along. You've basically been leveraging a lot of first mortgage activity with other partners, and those other partners are being paid to do that first mortgage work. So that's a great place to be in, because you could instead take that first position there, at least on the broker side, and still be the lender on the down payment assistance or the second mortgage, but you'd be able to at least get paid to originate the first mortgage, which, remember, is often 2% or more of the first mortgage loan amount. So we're talking thousands of dollars. You can also have an opportunity to be a one-stop for home buyers. So if you are providing home buyer education and counseling, or down payment assistance, or a combination of those, or maybe an in-house portfolio product, any combination of those means that if you had the full range of loan programs in the first mortgage position that are in the market, that you really could be a one-stop solution for a home buyer. They can come to you and get any loan, essentially under the sun, with with asterisk, but you'd be able to offer them the full range of options, and they wouldn't really need to go anywhere else. Some threats to consider that would again cause pause: if you have little to no capital to launch a new brokerage, we try and work with folks to minimize the financial risk to a new business line in brokerage, and we design the protocol, the steps in their action plan to support that, and the way that we've structured positions. But at the same time, it does take some investment. It's an investment of time. There are systems to purchase. Often there's new insurance, right? We spoke about earlier. So you've got to have some working capital to get into this space. And that's really important. If you have nothing available to support the new business, then that would be a place to start as well. If you have zero home inventory and a no outlook of any addition, where you really are, everyone in your market is competing for a small set of buyers and there really just aren't enough to go around, then that would cause pause as well. And then finally, if you have very strong competition in your market that are really well known in this space, where you would have a hard time breaking in, that would be another cause for pause. And you really need to think about, what would you do to amplify marketing, messaging, etc. Because if you're going to go in and compete with an existing brand, then you're going to have to put the messaging out there. It's going to take more than one person showing up at an event here and there. Really going to have to spend some marketing on ads. So with that, I'll leave it on this slide, and we'll pause for any Q&A and thinking through your launching a mortgage brokerage and some of these considerations.
We have a question in chat.
Okay.
Okay.
Oh, I got it.
Got it. It's a long one.
Can you add Chickasaw Community Bank to your list for a Native American CDF?
It's not really a question. It was just asking if we could talk later and if you would add us to your list of wholesale lenders. That was all. We're 100%.
Oh, right.
Sure.
Yeah.
Very often people don't realize that we are a wholesale lender, and there's actually a couple others that specialize in the HUD-24, First Tribal and some others as well.
Yep.
And I know you do the whole gamut of CDFIs, but I just wanted to point that out. And we have done 2.5 billion, so I probably should have waited at the very end. Sorry.
No, that's great. No, we appreciate it. And actually, you have been on the line. We talked about you with CPCBC, so you are on the radar, and we really just pulled the top 10 list as an example of data.
And there's 2 or 3 of us. We're not the only one. I mean, they're my competition, but First Tribal and 1 or 2 others as well, although they're not necessarily CDFIs. They also wholesale. There's somebody that, and the reason I brought it up was because they keep talking about there's not a secondary market for HUD-24s. And there really is, and it's been very active and been active for years. So I just want people to know that there is, in fact, a secondary market for HUD-24s, both us, First Tribal, some others. Because that's also discouraging. If you start up a mortgage company and you go to some of the national ones, they won't do HUD-24s. So
right.
Mm-hmm.
And
Yeah,
probably,
no, I mean, that's a, it's on the list as a what I call table stakes, right? Where you can't show up to the table without these table stakes. And certainly in the native CDFI space, if you don't have 184, you know,
that's what a lot of CDFIs in the native community are looking to do, because one, they don't have the home inventory on the reservations. So they've got to build, so you've got to have that expertise, and you have to have the leasehold and or allotted expertise. And so, several programs are prohibitive of that as well. So, and the one other point I wanted to make in your quotas when you're considering lending, the lenders, the MLOs, the average doesn't necessarily pertain to HUD 184 loans. They're manually underwritten tribal trust. So as a staff, as a boss, specifically looking at your MLOs, at least during the initial phases and probably the first year, getting up to speed on lending on tribal trust. I mean, Steve Barber, I think, is on, Joanna's on. We've got a whole focus group that we spend trying to improve that process and shorten it up. So that needs to be in the consideration too when you're looking at timing.
that's great points. Thank you, Nancy. Yeah. The other thing I would make in your loan count too, I'm not sure if I said it, was if you have a first and a second, you've got to count both loans, because that could be one transaction, but really it's two separate loan processes that must be followed.
And I just want to throw out there that when we do these, this is is presented as a training on a national level. So normally we would work with an organization and we would pull the top the top lenders for a very specific audience. It might be, who has the top Native American loans in, the Shawnee, Oklahoma MSA.
Right.
Because we're talking to a national audience, I just went with the national wholesale.
And I bet with 2.5 billion, Nancy, you show up on some of those lists.
Mm-hmm. Yeah.
Jennifer, is that when you pull those customized lists, is it by race or by on trust land? Is it just native borrowers?
I'm limited by HMDA data.
Mm-hmm.
So if you gave me the trust land census tracts, I could pull just trust lands. People are usually looking to do when they come to us is to lend to everyone, and have an availability of loans beyond just the HUD 184s, so that they can lend to people in other parts of, they're living, in other parts of the MSA. So they might want the entire state. They might want a city, a county, an MSA.
Right.
But we are capable, certainly, if you tell me the census tract numbers, I can pull, I can go down to as tiny as a census tract. And then I can differentiate by anything that's HMDA data, race, gender,
loan type,
age,
loan use, loan size,
income levels.
I mean, there are a lot of variables, and we tend to focus on geography.
So long to write.
Well, I think you kind of really want to know who your biggest audiences are, but it's possible. It's just that you have to be able to, it has to be based on information that is collected on every loan.
And it's hard to get the census data for all the tribes across the United States. But also, and to your point where you're talking about all different loan programs, the HUD 184 isn't perfect for every single Native American either. So
right.
CFIs, it is it's probably one of the best for doing it on tribal land, unless you're going to do the VA program directly. But having the ability to do other loan programs is also good, because then it gives the Native American the best choices available for them personally.
Right. And brokerage is, you are representing essentially the exception, right? And brokerage is mostly going to be off tribal land and fee simple. And what we've seen is that there's quite a few native CDFIs that are serving a broader area, not just the trust land. And they do in fact have, tribal members that need and are looking to purchase a home off of tribal land and, need that service. And this is an opportunity to serve that customer and bring in some revenue for your organization, take care of your mission.
But it could also work on tribal land as well.
In the case of Hub 184, yes. When you're talking about FHA, VA, the state HFAs, the conventional lending, no. By and large, no. Not unless that tribe and that land has a specific agreement with the GSEs. And so, this brokerage activity is primarily for off-reservation lending.
I mean, I guess I have to take a little bit of issue for that. I think it could work anywhere as long as, you're right, that's where the volume is. Not that I disagree with that, like that's what it was designed to do. But if you have a tribe, and as many of them in New Mexico have done, it, that has an MOU with Fannie Mae, then, they can do conventional lending there. And, that's just another tool in their toolbox. So
yes, in the few exceptions, right? It's what I don't want folks to walk away thinking, Joanna, is that conventional lending applies, greatly in tribal land, because it doesn't. There are very few places where you can do that. And so that's why the HUD 184 loan exists and why it's been so prevalent, and because it does have a successful execution. And so, we just want to be realistic to say that, that brokerage is not selling your loans that you have on portfolio, and brokerage is not necessarily a pathway to being able to solve for, on trust land lending, unless you are brokering the HUD 184, unless you've got, your specific tribe has that MOU in place, which there's only a few of in the country.
Yeah, and some native CDFIs are looking at USDA 502 as well. The whole issue is really liquidity, is liquidity. And HUD 184 is a great product, but less than 10% of the loan volume in the history of the program is on trust land. So if you're trying to crack the trust land net, then you have to look at all options.
Right, and to say that though, Joanna, part of the reason there's only 10% is because not everybody's applying, so the brokers and everybody else can help get more people into the pipeline, so more of it can be done.
Well,
Yeah.
I think that's why we recommend a full range, right? So that you have everything that available if someone comes to you and that is what they need. The goal is you don't want to have to turn anybody away. You don't want to have to say, we don't do FHA loans, so you have to go to so-and-so. Your goal is that everybody that walks in the door can get a loan from you.
Yep.
Right, but a native CDFI is not going to do FHA, because FHA, like that market, like that falls into the category of a market that's already taken care of by other borrowers. They might refer someone to a.
No, Joanna, I'm sorry, I
Nancy.
disagree. But if you are a broker and you have taken in a client and they have said, hi, Joanna, I would like you to originate my loan. And you, Joanna, have a wholesale access to an FHA product for me, and that is the right match. I do not know why you would do that. And I think you would.
No, you would. You're right. You would if that, but that's typically not what a native CDFI, it depends on the native CDFI.
There aren't many native CDFI brokers yet, are there?
No, it really, you're right. I mean, it depends on the native.
Wait till you see the ones we've worked with be up and live for 6 months, and then we can circle back on what we think a native CDFI broker does.
A lot of the CDFIs, not native CDFIs, but the CDFIs in general, nonprofit CDFIs that we have worked with, actually look at the brokerage as a way to support their mission work without grants, right? So it's a source of, it's a social enterprise. It's a source of stable revenue that comes into the organization. So they will lend to anyone. not, you know, they will lend to anyone through their brokerage. Usually it's a separate corporation that they've set up, and they will do jumbo loans. They will
Right.
do any type of loan that walks in the door, because they see it as then the money that comes in from that goes into their mission-based work.
That's right. This here is this lending ladder just gives people an example. This is a $200,000 first mortgage loan amount. We are talking about the first mortgage broker here, this chartreuse green section. And so, yeah, you're you know, on a $200,000 loan, that's $4,000 in revenue. As it compares to DPA fees, you know, we see nowhere, not very few folks do we see getting the 1750. More often on DPA lending, people are getting 250, 350, 450. So this is, you know, 10 times as much revenue, and it's often the same borrower, the same transaction, and you know, it's just an activity that they are not engaged with. And when they are engaged with it, then they can do all of this and bring in this revenue to the mission.
So it definitely goes back to your step one, and all this whole process is
Oh, sorry.
step one in the whole process is to go to your board, because a native CFI
Right.
might have to change their target market to go beyond the reservation or to go to other areas. But a native CDFI by definition is not less than 51% of their activities to well, it depends on how they're defined, to native people or native areas. So that's an important consideration as well too.
Right, and that's going to be balance sheet lending, right? So brokerage loans, I'm glad you raised that point. A brokered transaction that does not hit your balance sheet, and it would not actually change your CDFI ratios or numbers. It doesn't count towards CDFI, doesn't qualify. So because it's someone else's loan.
But even the portion of your activities that for a native CDFI, because
right, and it's the same thing for native as LMI or as a minority focus. There, it's your target market population, and you have to have 51% or greater of your production in that target market population. And so the only things that count toward that measure are things that hit your balance sheet as the CDFI, where you are the lender of record. And in all brokered transactions, you are not the lender of record. And so it doesn't help any sort of CDFI qualification at all, because it's off balance sheet activity. It's just revenue. It would just look like program revenue is all it would. That's the only thing that would affect the CDFI is the revenue line.
Okay.
Yep, and it's not their credit product, so it's just program revenue. It's like someone gave you a grant or any other type of non-specific program activity income. Well, this has been a great discussion. I hope that you all have found this useful and that it's maybe brought some different perspectives to thinking and helped you consider when this may be appropriate for you and when it would work. Hey, Steve, how are you?
Hey, Gabe. Yeah, very good presentation. Thank you.
Good. Any questions or thoughts to add?
No, I think there's some really good points, just to that last point about, the off balance sheet, you may have your second mortgage, depending on where it's coming from, could be on balance sheet. So, and count towards your CDFI, right? If it's a loan.
Like CDC is like that. They may have a second lien for a qualifying, member of the tribe who they lend to, and they could broker the first and be the second lien lender. But that borrower would have to be a qualifying borrower right out of the gate, right? So it would already be a tribal member for them.
Yeah. Could I ask, and I'm sorry I came in a little bit late, but did you talk about the interplay between housing counseling and lending in terms of, some separation there? I don't know, what do you typically counsel on that?
The firewall is really a fire brick is our phrase from our friend Lupe that came up with that one. but basically, you know, housing counseling agencies need to have at least 3 options as lenders. You can be one of those loan options. You want to provide that to every single housing counseling client. You want to document it in your file. You're going to put it into your con log, but you can absolutely be the #1 choice on there and be a choice on there, whatever you want to do. And as long as you have from the housing counselor given that choice to the consumer and documented it, then you can make a warm referral after that and help them actually get an appointment to meet with your in-house loan officer and be pre-qualified. You know, that there are many housing counseling organizations that also have lending products internally or that are brokers. And you know, Steve, I ran one for a long time, and you can absolutely maintain full HUD compliance and still provide the loan and lending option to these consumers. In our triage, this is another thing that we would say, Steve, is that that you see in the routing, we actually don't have the best practice, or the recommendation is, or I guess this would only apply to someone who wasn't mortgage ready.
Yeah.
Because then they went to housing counseling first, they got mortgage ready, then they were given options, then they get routed back to loan officer and outside choices. But if they're mortgage ready the day they meet you and you're a licensed organization, our recommendation is you make them a loan client, and that they become a loan client first, and then your loan officer refer them to your housing counseling agency in your housing counseling services, which can then have a direct one-to-one referral with no options provided. That's not a requirement. So, so if someone comes to you and says, I want a loan, and they're ready, make them a loan client and then refer them over to your housing counseling.
Yep. Oh, good point.
Could give you the 5-minute warning, Gabe.
Okie doke.
This is awesome stuff. Thank you, guys. It's great, really good stuff, just to have the nuts and bolts of the process. I just hope that people don't feel like they're drinking from a fire hose, and realize that, you know, you have to be able to handle volume to make it work. So it's okay to take sips, but eventually you got to take the hose, right?
Yeah.
Okay, but I think you should talk about Climb.
Right, I was going to say we're happy to help folks with Climb. If someone's interested in this, we have a specific engagement in our Climb program around helping nonprofits become mortgage brokers. This year, we're working with CPCDC, Forbans, and Cook Inlet, who are all OESTA native CDFIs, and each of them have chosen to move forward and work on their mortgage brokerage activity and planning. We've completed CPCDC's Climb, and I have a lot of hope that they're going to be very successful. They already have a lot of in-house capacity and knowledge, and they're going to sort of start with the folks that they have. And then as those folks, see 1 or 2 loans happening a month, then they're going to trigger hiring a loan officer. But they meet all of the qualifications for a standard license. They meet all the qualifications for wholesale approval. And they do, in fact, have requests for folks that they're referring out to other lenders that they could keep in-house and originate themselves. So we're excited to see them launch. They're going to be working on their licensing over the next quarter. And I think that we'll see them launch their brokerage before the end of the year. And we'll be able to report back and have them, be an example along with Forbans and Cook Inlet as we learn how that goes for them.
Great.
Wonderful. Thank you, Gabe, Jennifer, and Dawn for joining us, and of course for the lively discussion that we had on this topic. So a lot of good resources. And I just want, before we close out, I just want to refer to the plenary, the closing plenary. You don't want to miss that. It's Synergy showcasing the work of NCDFI coalitions and networks and closing remarks. Plus, we also have an interview with an amazing person out in Kauai. So you don't want to miss that. It's going to be really great. And then we also have honor song by a native drum group. So lots to close out today. So 2:45 to 4:15, join back in a few minutes, so get a chance to refresh and such. So wonderful discussion. Thank you all, and we'll see you in a bit.
Thank you.
Thanks for having us, Danelle.
Thank you.
Bye.
Thanks, guys.
See you, Joanna.